record. There we go. So morning everybody, welcome to session 2 of our co-op finance and accounting session. Really nice to have everybody with us. I think I was just saying to Gauthier before we started, it was a really great session on Wednesday. Blew my mind a little bit, but I think everything was so clear, and to just sit down and go through it all was really, really useful. So looking forward to the more practical elements today. So without further ado, I'll hand over to you, Gauthier.
Thank you very much. Yeah, so welcome everyone. It's good to be with you again. Yeah, I mean, what a beautiful way to end the week with doing a bit of bookkeeping on Friday morning. Yeah, so I mean, hopefully, you know, we'll kind of do quite a lot of practice today, and that will make things a little bit clearer from all of the concepts we went through together on Wednesday. Okay, so I'm just going to share my screen. Okay, can everyone see this?
Good for me.
Yeah. Okay, brilliant. Excellent. So yeah, so today we kind of will go through a lot of the practice of bookkeeping. I have shared with Alan, and then hopefully got shared or got passed on to you all. So there's a bit of material. One thing was a Gnucash file, which is basically a template for bookkeeping for housing co-ops. So I'm not sure whether everyone has been able to install that template and also then install Gnucash. And so if the people that haven't, just if you can let me know now, that would be useful. And it's okay if you haven't, because obviously I will share my screen and I will do the practice as well, you know, on screen, so people can follow. But it's just good to know if people haven't been able to install this, or also if you had any trouble to do it, let me know. Okay, so it sounds like only one person haven't. Yeah, but again, that's completely fine. And then if you do run into any issues with installing Gnucash or working with the template, you can also contact me directly. I think you have my email and things like that, or even my phone. I think I've shared my phone with Alan. Okay, great. So basically, so today we'll look at So yeah, so today we'll look at the basic on how to use Gnucash. So Gnucash is a bookkeeping software. So to do the basic bookkeeping for housing co-ops, and we'll also hopefully will have time to look at how to use it to generate basic financial reports. Okay, because again, we sort of talked about last time that what's useful is not only to do the books, but also to be able to extract the meaningful financial information to present to your members, and eventually as well for you to do your annual reports, which are your kind of legal duties. Okay, so before we get into Gnucash directly, we'll just talk about what's involved usually in doing bookkeeping. Okay, and what kind of tasks need to happen. Okay, so one is the obvious, which is the regular input of transactions. So when transaction happens, ideally, it's sort of good not to wait for too long before you actually put them into your books, because sometimes things can be forgotten. Also, especially if you handle cash. So the main mistakes in bookkeeping have to do with cash handling. So depending on the size of your housing co-op, or depending on what activities you are doing, you may or may not use cash. Many housing co-op don't use any cash, and I would say that if you can avoid to use cash, that will probably make your life easier in terms of bookkeeping and accounting. Okay, the other task that needs to be done regularly, I've sort of put sort of time scale in bracket, kind of monthly or whatever, which is a bank account reconciliation. And this is basically checking that the list of transactions that you've entered into your books, and particularly into your bank account in your books, actually fits what's actually happening in your real bank account, i.e. it does reflect what is happening on your bank statement. Okay, so both your ledger for your bank account in your books reflects your bank statement. And again, so it's a good idea to do that regularly. In practice, especially nowadays with like internet banking and the fact we use less check and everything, you can probably do the input of transaction and the bank account reconciliation at the same time, because you probably will use, in fact, your bank statement to do your bookkeeping. You kind of download the transaction from internet banking and you use that to do your books. So you might do that at the same time. And then, but not all of the transactions that needs to go in your books are in your bank statement, right? So it's not only like the reconciliation with the bank account is only one part of the bookkeeping or one part of the input of transactions. And I suppose the third key task that needs to happen in the book, or yeah, that is a good practice at least, is at the end of the year to close your books, which basically means that when the financial year is done, then you kind of reset everything, so you start again from fresh for the next financial year. We'll look into it in practice anyway. So yeah, so we don't necessarily need to expand, but I just thought it'd be useful for you to have those three points. Okay, so I'm just going to talk a little bit about Gnucash as a software, because there are a few different accounting software that you can use, but I was asked for these sessions to actually give an intro to bookkeeping using Gnucash specifically. Gnucash is a software that we use very much at Catalyst, and for several reasons. One is that it's free, as in you don't need to pay for it, so then it's sort of accessible to a lot of clients. The other point is that it's free in the sense of software freedom, and that means that it's developed in a way that anyone can look at how the software is written and therefore look at what the software actually does. And with that in mind, it means that people are checking, for example, is the software actually extracting financial information and selling it on to other people or anything like that. And so that sort of guarantees that Gnucash is not one of the software that will utilize your personal information for other purposes. And then we like promoting and encouraging the use of those kind of software. But one good thing as well about Gnucash is that it's a very straightforward way to do your bookkeeping. It's a little bit old school in the sense that you sort of got a ledger. The way it looks is a bit like an old kind of book ledger, right? You're sort of entering your transaction. It's not very fancy, but then it's very kind of straightforward and accurate, and that we think is good, and it sort of allows people to really grasp how to do good bookkeeping. It's also a software that does double entry bookkeeping, double entry being a concept we talked about last time, which again is sort of the norm, and really you need to use software that does double entry. Now, the thing that Gnucash is not so great for is if you are a large and complex organization. So Gnucash is good for small to kind of middle-sized like enterprises, but it's not so good if you're like a big group or anything like that. Then it doesn't quite have all of the capabilities that other software may have. Another thing that's not brilliant about it is that it kind of looks a bit dated, and therefore it's not very friendly. Yeah, and can put people off a little bit. Okay, so just someone asked in the chat, where can we get the template? So yes, so Claire shared the link. In that link, you will basically have access to a folder with lots of different files in it. Some of those files we will use anyway during this workshop, so it's good to kind of have that folder open or download all of those files. But the template is the file that ends with a .gnucash. Okay. So what we look at today really is how to, or at least we will try to go through all of those different aspects of Gnucash, which is how to create, remove, and edit accounts, how to enter a lot of different kinds of transactions, how to create scheduled and split transactions, which again we'll explain what that is, how to close books, how to do your bank reconciliation, how to import transactions. So that's mainly thinking of how to import transactions from, say, internet banking. And obviously different banks use slightly different format or like export formats, but Gnucash should be able to handle most of them. And then lastly, how to do basic reporting. Okay, so I'm wondering if we did get a few more people, just because we're now going to start the practice. So it'd probably be good to have everyone here. Casey, do you think is it worth to wait for more people, or do we think we have everyone?
I think that Harry's just joined us, so welcome, Harry. But I think other than Alan, I think we're all good to go. I'm not sure if the rest of the team can spot anybody that's missing before we get going, or if anybody else knows of anyone that's joining us today. No. Yeah, I think we'll get going. It's being recorded anyway, so we can always share it with anybody that's late if they've missed anything vital. If that's okay with you.
Brilliant. Yeah, sounds good. Okay, so hopefully people can see my Gnucash window. And so people that have installed the template should see the same thing. So maybe do let me know if you don't. But I will assume that you do.
Sorry, because I was late and I'm sure you just said this, but how do I get the template open in Gnucash?
Okay, so if you have installed Gnucash,
yeah, I have that, and
I
have
if you have downloaded the template,
yeah, just double click.
Yeah, normally your computer should recognize the file format as opening with Gnucash. Are you using Mac or Windows or Linux?
I'm on Mac, and yeah, because it opens when it opens. Is it like import my QIF files?
No, that shouldn't be the case. Okay, otherwise, if you just open Gnucash, the software, and you go to File Open,
File Open,
and then you select the .gnucash file.
Okay. Okay, yeah, I'll be working on that while I'll catch up. Well, thank you.
I mean, let me know if you still have troubles there.
Yeah, I'm just messing with files at the moment.
Okay. So the other file we'll be opening is the one that says house purchase.pdf. Okay, so basically what we'll do to start with is that we'll start as if we were like a new housing co-op, and we've just like bought a house. Okay. Although we will sort of pretend we are backward in time, and that we bought the house exactly a year ago, so on the 19th of November 2020. And so we will start with like entering the transactions that have to do with both the house purchase and the house financing. Okay.
Yep.
Okay. So has everyone got these like PDF documents? Everyone be able to get that?
Yeah.
Fantastic. So, so the first thing we will enter is the money we got as loans. Okay, so, and we will start with loan stock, because if you do actually go through the process of a house purchase, there's one thing that happens with your mortgage is your mortgage does not usually actually come through your bank account, but gets paid directly to the seller. Okay, so we see that the way you input the mortgage in your books is a little bit different to another kind of loan. Okay. So on that PDF, it says that we have three loan stock investors. The three of them have invested the same amount, so £45,000, but at different kind of rates and for different lengths of times. And so it's a good practice in your books to keep track of the investments of each different investor. Okay, so because it's going to be debt, it's going to be entered as liabilities. Okay, and it's going to be what we call a long-term liability. Long-term because it is money that's due to be paid back after more than a year. Okay, so any debt that's due to be paid back within a year enters the category of current liabilities, and anything that's due to be paid back in more than a year enters the categories of long-term liability. Okay, so we got that category, long-term loans. I also created a category called loan stock within that. Okay, and if we open up the arrow, then we've got a list of 2 investors. Okay, so the first thing we need to do is to create a new account to list the 3rd investor, because we do actually have 3. And so to create an account, you select the parent account under which you want the new account to be created. So in that case, it will be loan stock. Okay, and you either click on the icon that says new on the top bar, or you right click on that account and you should see a menu. Hopefully you can see. Can you see everything? Can you see the menu opening and all of that?
Can't see the right click menu if you've got that open.
You can see the right click menu. Okay, so what I'll do, I'm going to share my entire screen instead of sharing a window. So just bear with me a moment, because it would actually be useful to see menus. Can you see the right screen menu now?
Yeah.
Excellent. Okay, so again, so either you kind of click on the icon that says new at the top, or you right click and you select new account. Okay, and then you've got that little window that appears. And so you select, so new account, so you give it a name. So in that case, we'll just call it investor 3. But if you add the actual investors, so you may or may not want to actually write their name in there because there's a level of anonymity that you want to keep when you deal with investors. But you would want to call it something that allows you to identify who that is. Okay. So when you create an account, there are several like fields that you don't necessarily have to fill, but they're just there. So the name, obviously, sometimes you use account code in accounting to identify accounts. You don't really have to do that. And you can give it a description as well. So this is if you want to add additional information about what this account is about. You can give it a color, which again, you don't have to do this. And I don't normally do this, but actually I do it in this case mainly so it's easily identified. It's easy to identify what is liability, income, expense, or equity, but you really don't have to do this. And then if you look below, there's account type. And this is where you kind of specify what kind of account that is. Okay, so in our case, because it's a loan, it's a simple liability account. Okay, but we see that there are several types of accounts. And we sort of go through a few different ones today, but just so you know, like kind of loans will be straightforward liabilities. If it was a bank account, then you choose the type bank. If it was an account you handle cash with, you use cash. If it's another type of asset account, like a house, for example, you just use assets. Okay, and there are a few different ones there. If there are accounts in which you use either invoices, so invoices are the co-ops do to clients, then you would use a type which is account receivable, which we talked about last session. And if it is an account in which you're going to enter bills, so i.e. invoices, but from suppliers or contractors, so bills that the co-op receives, then you use the type. So it's also a liability, but you in that case, you would use the type account payable. Okay, so I'm just going, you don't necessarily need to kind of note or sort of remember all of the details, especially because the session is recorded, but I'm just sort of talking so you know that information in case that happens to you in the future, and you can come back to this recording and you know, hopefully get most of the information you need. But anyway, for a loan stock, you just use the liability account. Okay, so now we've got our 3 investors. So if we now open one of those investor accounts, so to open an account, you kind of double click on it. And when you double click on it, then you got the ledger. Okay, and the ledger is where you enter all of the transactions. So what's happened with all of the loan stock investors is that they've all put in money, and that money arrived in our bank account at some point in time. Okay, right now we don't know when it happened, and we'll look at it when it actually happened when we will open the bank statement. But we know that the purchase happened on the 19th of November, so we know that the money will have had to come in before that time. So we will just put a random date for now, so say the 10th of November 2020. Okay, and so we can write you know, investment. We can maybe write the terms, so that's useful to kind of remember. 5 years at 0%. And then we need to choose where is that transaction, in which other places is this transaction going to be recorded to. Okay, because as we said last week, bookkeeping is done in a fashion that we call double entry. So every transaction is recorded twice, one which explains like what it is, and also how it affects our finance. And so we know that this is a loan. It is a liability, so we enter it in liabilities, but the money also arrived in our bank account. So we're going to record it in the bank account. Okay, and so you open this drop-down menu, and in that drop-down menu, it lists all of the accounts that was created for the co-op. And so in that case, we just choose the second from the top, which is assets, current account. Okay, and there, in here, you've got to say whether that transaction has increased or decreased your liability. Okay, in that case, because we're taking out a loan, this is the point in which we take the loan in, it increases our liability. So this is where we're going to enter the amount, so 45,000, and you press enter. Twice, actually, you press enter. And that's it. And now the transaction is recorded, and we're ready to enter our next transaction in that same account if we needed to. Okay, and then if we go back to the chart of accounts, which is the first tab, and if we go to assets, current assets, bank account, then we see that that transaction has also been entered there. Okay, and it's automatically understood that because it's a transfer that increased your liability, it was entered as a deposit in your account, i.e. as money coming in. Okay, and so now your bank balance says 45,000. Is that clear for everyone? Am I going too slow, too quick, or okay?
It's good for me. Thank you.
Yeah, it's good for me.
Yes, it's good for me.
Excellent. Okay, brilliant. So now basically, you have to do the same for all three investors. So if we go back to the chart of accounts, and I'll of course do it with you. So but maybe then I'll do it a bit quicker or something, so you get a chance to work it out by yourself. So investor 2, the date. Again, we just say for now that it's all arrived on 10th, 11/2020. Investment. And the second investor was 10 years. And it was 1% interest. Okay, and we do also investor 3. Same thing. And so once you're done with your 3 investors, and if you go back to the current account, then you should see a bank balance of 135,000. So maybe just let me know when you're at that.
Yeah. There.
Yeah, I've done it as well. I have a thing, the description field. So like in the it does like do the descriptions from the transactions reflect on the main page, or is that description on the main page just a description for that account rather than, but the description when you're in the account, that's per transaction, that description is. Does that make sense?
Yeah, so the description when you're in the account, the description you're entering it is a description for each transaction.
Ah, okay.
Okay, so you're entering a description for the transaction. The other type of description that we looked at, which was a description for the account. So for example, if I go here to the current account, it says, so the name of the account is current account, and there's a description for it which says it's a current bank account.
Okay, yeah.
Okay, and that's a description for the account, which you only enter if you do edit account and it's in that field.
Okay.
Okay, but
yeah.
then you've got to enter a description for each transaction that you're making.
Okay, yeah, because I was thinking it could be like useful to like from the main page, I could like, you know, so you can then see all the loan stock. Yeah, cool. Okay, that makes sense. I just a bit confused.
I mean, from the main page, from the chart of accounts, you can actually see the total. So this lists your total liabilities,
Mm-hmm.
and then which is at the same, because at the moment your long-term liabilities are only loan stock, it will be the total loan stock, and then it will sort of give you the total,
Yeah.
like the balance, if you say per account.
Mhm.
Okay, but it doesn't give you a list of transactions because in an account you're going to have a lot of different transactions, so you can't really see the list of all of the descriptions from the main page.
Mm-hmm.
If that makes sense.
Yeah. Okay, tough.
Okay. And then there's one thing in Gnucash. So now we could also have entered the transaction by staying in the current account. Okay, so by being in the current account, I could have entered, and don't do this, but I'm just showing it to you. So investment, and then one thing that you notice right now is that Gnucash remembers if you've already entered a transaction that looks the same. So I've just tapped I, and already it filled in automatically the rest, because it says, oh, you know, maybe you're trying to enter the same transaction that you already entered before. So it filled in the field automatically. And then if you press tab, then it will also fill the rest of the fields automatically. Okay. So of course I need to change the date here, but okay, so that automatically set investment 5 years, 0%, investor 1. So this is where it lists automatically in the liabilities, 45,000. Then if I press enter, I just added another transaction for the investor 1. Okay. Obviously, that is wrong because we don't have 2 transactions for investor 1. So if you enter something that isn't right, then you can delete transaction. So you select the transaction and you either press the delete button at the top or you right click and you do delete. And that's it. Okay. In terms of dates, Gnucash will always sort things by date, which means from the older to the newest. So it doesn't really matter if you, for example, forgotten to enter a transaction that happened before or in between 2 dates or anything like that. You can just enter whatever date you want here, and the transaction will automatically be sorted in the ledger. Okay, but we'll probably look at that later anyway. Okay, so we've entered the loan stock. Okay. 40,000. So now we will enter the mortgage. So the mortgage is another type of long-term loan. Okay, so this time, we want to create a new account called mortgage account, which will keep track of how much debt is outstanding on your mortgage. Okay, so then the parent account in that case is long-term loans. And so if you right click or if you click on the button at the top that says new, you create a new account, mortgage. You could even maybe write a bank. For example, if it was a mortgage with Ecology Building Society, you could write EBS mortgage. It's kind of really up to you, yeah, while you write in names and descriptions and transaction description. It's just for your book to make sense to you and ideally to your members. Okay. I forgot to put a color. Again, the color is really here for illustration purposes, but you don't have to use the colors. Okay. So, everyone be able to create that account?
Got it.
Yeah. Fantastic. Great. So this time, so as I told you, the mortgage doesn't come as actual cash into your bank, which then is transferred to the seller. It goes straight to the seller. Okay, usually through through a solicitor and stuff like that, but basically it goes through the bank to the seller. Yeah, and the kind of solicitor with sort of all the money in trust in during the transactions. But so which means that the mortgage basically starts on purchase. Okay, so we know the purchase date, which is the 19th of November 2020. So this is when we start. And so we say mortgage taken out. Okay, and so this is where conceptually we need to think of what is the corresponding transaction in here, because it's not, this time it's not that the money goes into your bank, but from the core perspective, the money is actually converted directly into physical assets. So it's not converted into cash. So it's not cash. It's not a liquid asset, but it's converted directly into physical assets. Okay. So actually, it will correspond. It will. If you say like correspond to part of the value of your house. Okay.
Yep.
So in that case, the transfer, instead of going into assets, current account, it will go into a form of fixed asset. So it's still in asset, but fixed asset and the house. Okay. So again, it will increase your liability. So in that example, we said that the mortgage was 360,000. And so on a little PDF paper, I say that the mortgage is 360,000, where the property cost, so the purchase price effectively, is 450,000. And so the mortgage only covers a certain proportion of the house price. Okay, and in that case, I said, okay, this is because the mortgage covers 80% of the purchase price. And this is because mortgage lenders will only lend, will usually not cover the full property price. Okay, and that's because they want to keep a bit of leeway. If something goes wrong, they want to be able to sell the property and recover their money. Okay, in case they can't sell the property for the same price, or there's a crash in house prices or whatever it is, they normally won't lend the full property price. And some lenders have different policies to how much of that proportion they will lend. This proportion is also called the loan to value, or LTV in jargon. So again, different banks will do different terms. So Ecology Building Society, for example, lends to usually 80%. I think Triodos, we usually do more, something around like 70%. I think Unity Trust as well is more looking at 70%. I mean, just for you to know in case you need to approach banks. But yeah, it's important to kind of look what terms different banks do. And then you can also approach other organizations that can lend above that percentage. So for example, you can take a primary mortgage with a bank like, or a building society like Ecology, and then you can take another loan from, say, cooperative and community finance or Radical Roots, which will then lend on the more risky portion, so from the 80 to the 100% portion of the property price. But then usually those loans are going to be more expensive, okay, because those organizations take more risk. They usually charge a bit more as well. Okay. So back to the books. So we've entered the mortgage transaction. So this says basically you owe the bank 360,000. Then if we go back to the chart of accounts, you go to fixed assets, you go to the house, then it lists like the value that says that's entered is 360,000. But of course, this isn't the full price, because the other thing that happened is that the full price was obviously 450. So you've also used some of your loan stock to buy the property. Okay, so this is a transaction that you want to add on. So if you open the house accounts, so it's again in asset, fixed asset, house, you see the mortgage. But then you want to add another transaction which supposedly happened on the same day. Okay. Right. Additional payment towards house purchase. And this time, this is money that will come out of your bank account. Okay. So you've got to see whether that transaction increases or decreases your house value, and this is going to increase your house value because it's part of the purchase. And so we know the purchase was 450,000. We've got 360 from the mortgage. So there's a remain. So we're missing a remaining 90,000. Okay. So then we've got those two transactions that total to the property price. Okay. Does that make sense? Or do people have any questions at this stage?
That bit made sense for me, but I had a question of
Sure.
when I did the when I put in the mortgage, I think I mistakenly put it under the sort of loan stock subheading. Is there a way that I can sort of on the main screen just like move it, or would I have to completely like remake that account, like the mortgage account under?
Yes, you can move it.
Yeah. How would I do that?
So if you right click on the account,
Uh-huh.
so I'll just do it with you, even though I didn't make the thing. But so if you edit the account,
Edit account.
you can choose again here
Ah.
which account is a parent account. Okay, so
Ah,
supposedly here you chose loan stock.
Yeah.
And then you can just choose long-term loans, and then the account will be moved.
Cool. Thank you.
No wrong. Okay. So it is a good practice to also save regularly your Gnucash file. Although Gnucash which saves automatically, yeah, every few times, but it doesn't hurt to save as well. Okay, so you've done the Gnucash, but I'm just going to share the PDF for a second. Okay, so in the yeah, hopefully you can see that. So as part of the purchase, we had several costs. So one cost is obviously the property price.
I don't think we can see it, Gauthier. I don't think we can
you
see
can see it. Okay, sorry about that. Can you see it now?
No.
Did you say no?
No. It just says has started screen sharing. Double click to enter full screen mode. I don't know really what that means.
Oh, that's odd. Okay, I'll just stop sharing for a second. Screen share. Still not working, I imagine.
No.
That is.
There you go.
Bizarre. I don't know what's going on.
can see it now.
Oh, you can see it now.
We can, yeah.
Oh, brilliant. Okay,
Yeah.
great. Okay, so as part of the house purchase, some of the costs were the property cost, which are actually property price, really, so 450. But then there are additional costs to do with buying a house. One fairly big one is the land transaction tax, which the buyer has to pay. For a house costing 450,000, that tax would be £31,700. Then it's likely that you might want to do a little bit of work on the house, which we see that amount will vary very much depending on which kind of house you're buying. But in that example, we say £5,000. You might also want to buy a few things to start furnishing the house or something like that. So in that example, of £2,000. And you usually will have some solicitor fees, so 3,000, and some loan fees, which is 2,700. Okay, and the loan fees is usually a percentage of the amount of mortgage that you're taking out. Okay, so there are all of those costs. Now, in accounting, not all of those costs are treated the same. And while it might sound a little bit counterintuitive, some of those costs are actually added to your assets. So in effect, to your property value. Okay, even though you buy the property for 450, in your accounts, some of those costs are going to be capitalized, so added to the value of your capital, instead of being treated as expenses. Okay, and out of those costs, the two costs that are definitely capitalized are the land transaction tax and the solicitor fees. Okay. In effect, what that means is that if we go back to the house account, we're going to add some other transaction here, which have to do with the land transaction tax and the solicitor fees. Okay. So hopefully that makes sense. Just let me know in the chat if it doesn't. So on the same day of the house purchase, we're just adding those costs in, yeah? So we
I think I understand the concept, but what is the reason that because does it mean that someone in the future, if they bought the house off us, they wouldn't have to pay the same tax? So we've effectively paid it, or am I misunderstood? Like, how come that does get capitalized?
They will have to pay the same tax. But I suppose the reasoning behind it is slightly unclear. It's to do with like strange rules around accounting, but basically it it allows to how can I explain this? I'll come back to this a little bit later, actually. Okay. We'll just get on with the transaction, and then I'll get back to this to explain it, because it's a little bit obscure. But
thank you.
And then there's a question in the chat that says sometimes loan fees can be included in the mortgage. So that's true. That's true, and sometimes what happens, like it can happen in loans in general, that in fact the amount that is being transferred is the total amount you're borrowing less the loan fees. In that sense, but it doesn't really matter in that case how you kind of treat it in your books, because the debt, the full debt, is still going to be the total amount of mortgage. Okay. So actually, we will also enter the loan fees, but we'll do that as a straightforward expense that the co-op has paid out of its own pocket. Okay, so loan transaction tax. So this was paid out of the co-op bank
Gauthier?
account.
Gauthier, are you
Yes.
putting that in Gnucash at the moment? Because we can only see the PDF.
Yeah.
Okay.
Okay, so I'll just stop sharing again, just to make sure we have no problem. And okay, so in the chart of accounts, if you put yourself back into the house, then you enter a new transaction that says loan transaction tax. And then this is money that's being paid out of your bank account. So it's linked to your bank account. And again, it increases the value of your house by, in that case, by increasing the value of your capital already, in that case, by £31,700. And by the way, do tell me if I forget to change screen, because I can't actually see on the Zoom which screen I'm sharing. So it's quite easy for me to forget.
Will do. Thanks.
Okay, and then we'll do the same for the solicitor fees. Okay, then in terms of the repair work, this kind of could be considered either. So it would really depend on what kind of work it is, and how that would impact the value of the property. And in this case, what we could do is we could actually put that as capital cost as well. Although actually, no, we won't do that just because of the purposes of entering an invoice. So no, actually, we won't do that in that example. Okay, so that is basically so this is kind of how you enter all of the transactions that have to do with the house purchase. Okay, and I'm thinking that it might be a good time to take a little break before we do the bank statement. Is that okay for people?
Yeah, great.
Yeah, sounds
Shall
good.
we take like 10 minutes break?
Yeah.
Yeah, that sounds
Actually,
good.
just to go on a round number, it's 27 now, so let's be back at 11:40.
Great. Thanks.
Brilliant.
Great.
Thanks, Gauthier.
Brilliant. Okay. So let's keep going again. Okay, so we have done the house purchase. But then there were some other costs that happened at the beginning, and especially the repair work. And for that, for the repair work, that the contractor sent us an invoice. So we're going to look at how we enter an invoice in Gnucash. So hopefully everyone has been able to get that invoice. It's just like a PDF file called CAT installation. Originally, I was actually going to use CAT as the Center for Alternative Technology, but then realized that I probably couldn't use them. So, okay, I will quickly share the invoice briefly. So can everyone see that, by the way? Just making sure.
Yeah.
Yeah.
Yeah. Okay, great. Okay, so the relevant information in an invoice for the bookkeeping is obviously who is the invoice from, the date, a reference number, which is always handy to then be able to find the invoice again, a description, an amount, and I mean, for other purposes, usually you want to know how you pay them, and what are the terms of payments and stuff like that. But for us, the information we need are up here. Okay, so I will now share Gnucash again. Okay, so to enter invoices in Gnucash, so there's kind of two ways you can do it, right? It's either you enter the invoice as a transaction, but if you do that, it'll probably be harder for you to keep track of how much you might owe this particular contractor if you use them regularly, for example, or if you need to look for an invoice, for example, it would be harder to enter it if you just enter the invoice as a simple transaction in a ledger. So the other way to do it is to actually enter it as an invoice in the system, which we'll do now. So in this case, so you need to open the business tab. And then in that case, it's a vendor. Okay, and because you don't have any vendor at the moment in the system, you've got to create a new one. Okay, in order to see all of the vendor you have on the system, you click on the vendor overview, and on this overview, we've got no one, so we need to create a new one. Okay, so we just write the name. It requires an address. You can't leave the field blank, which is really annoying at times, but usually anyway, contractors will provide you with an address. And so here is your contractor that's been created. And so if you then either right click on the contractor or use that button up here to create a new bill, then you've got this first sort of window which shows information about bill creation. And really the main relevant bit here is to make sure you've got the vendors right, that's the right vendor, the date on the bill. And so in that case, it's going to be the 7th of December 2020. And the ID. And for the ID, then it's kind of handy to maybe write whatever is written on the bill. Okay, there's a few different ways you can handle bills ID. But as long as you don't have too many of them, well, if you don't have too many of them, I would recommend to just do that so you can find them easily. But the idea is you can't really have two identical ID, as far as I can tell. So yeah, which means that if you have then two different contractors that actually happen to have the same IDs, then you might create problems. But in most cases, it's usually fine. Okay, so once you press OK, then you get to that page. And this is where you fill in the information that's actually written in the invoice. So again, we've got the date here, which is at what date a particular piece of work has been done. In that case, there's only one piece of work, so we just leave the same date. The description of the work. And then on what kind of expense account that go in. And so if we look at the expense account that we actually have one that says house maintenance. This is one we select. Then we enter quantity, so we just say 1 in that case, and the price, £5,000, not 55. Everyone is with me?
Yeah.
Great. Okay, so once you're finished entering the invoice, you see sometimes you have invoices with a lot of different things going on, so you can list them all, and sometimes even they might even correspond to a different type of expenses if you have a supplier that does different things for your business. In that case, only one piece of work. So once you're all done with this, what you've got to do is you've got to post the invoice. And posting the invoice basically means, in that case, we post the bill, meaning that then the bill is being entered into your book, and it's not like a work in progress kind of bill. Yeah, it's finished. You finish with all of the information. Post it. And so the post date should normally be the date in which that's also written on the invoice, so the date where you sort of received it. Okay. And the due date is the date by when it's due. Okay. Again, in actual practice for housing co-ops, it's not usually super useful, but still, it can be useful to keep track of when you are actually supposed to pay the invoice. Okay. So because the due date in this one is within 15 days, we see the due date here, which is the 22nd. Okay. This is best practice. In actual fact, it's likely that you might not bother too much with. So date, you just know you've got an invoice, you've got to pay it. You enter it into your books and you pay it. And sometimes you even enter it into your books after you've paid it anyway. So, I'm just giving you the concepts here. So then you press OK, and the invoice is entered into your books. So let's see how that has translated. So if we go back to accounts, so we said that we've associated the invoice with an expense, which was the maintenance. So house maintenance, we can already see that there is £5,000. If we open the account, we see the number 1235, that's the reference number on the invoice, the name of the contractor, the £5,000. Okay, but the question is with which other account has that transaction been associated? Because we see it's not money that you've paid already. You've just entered the invoice. So you've entered the fact that you need to pay that money. So in effect, this is money that you owe to the contractor. So it's been entered as a liability. And in that case, as a current liability, because you got to pay it within a year, in fact, within 15 days. So it's within current liabilities and within an account called accounts payable. Okay, this is basically where all of the bills that you receive will be until you actually pay them. So if you open that account, we can see the invoice, which has the post date, the due date, the reference, the name, where, like, what is the corresponding account. So in that case, it's house maintenance, and the amount. Okay.
I might
So
have
that's how
missed
you
some.
invoice it.
I might have missed something there, but how does it know that it's accounts payable? Sorry.
Okay, so this is actually a default setting, but you're right to ask. So if I go back to the invoice view, I'm going to unpost the invoice because this is actually when it happened. I didn't say it at the time, but when you post it, it actually says post to account, and this is where it chooses which liability account it goes to. Okay. By default, it will always use an account of the type accounts payable. So if I right click on this account and I do edit, then the account type here is selected as being an account payable. You could have several account payable or accounts that of that type. And then when you post the invoice, you could choose which one you want to select. Because in that case, there's only one, automatically selecting that one. Okay, for example, in an organization that we do the books for, we've got two types of accounts payable. One which is to do with like bills that we receive from contractors, and the other one which is to do with expense claims that that we pay to members doing work for the organization, or having expenses for the organization. So we've got two different accounts payable. That's because we want to keep track of how much money we owe to either contractors or to our members. And we want to keep track of that separately. Does that make sense?
Yes, it does. So that it means that you have to post to do the double entry.
Yes.
Yeah.
Yeah.
Thank
As
you.
long as the invoice is not posted, it's not actually in your books.
Yeah. Got it.
Okay.
Great.
What about VAT payments?
So VAT payments. So basically, it's true that I did create a fairly simple invoice in that case. So I didn't include any tax, but usually the tax breakdown will be detailed on the invoice. And because housing co-ops will not usually be VATable, you won't be VAT registered. You don't really care about VAT, so you can when you enter the invoice, you can just add the tax to the total price, or you can add it as a separate item, but it really doesn't make any difference to your housing co-op.
Right.
But it's true, actually. But you're right to point it out, and I did realize that, but then it was too late because I'd already sent the link to Alan. That the invoice was fairly simple, but just don't worry about tax in general.
If you're using this software for something that isn't a housing co-op, that would be different. I presume you'd have to
absolutely
put the So a company would worry about that.
Absolutely, yeah. If they're VAT registered.
If they're VAT registered, yeah.
Okay. So now we're going to we are going to do the bank account transactions I think there's one little thing I was hesitating to do or not to do. I'm just afraid that that's going to create more confusion than anything else. Because there's there's something that we haven't entered yet in the books, but which would definitely have happened in your housing co-op by the point you're buying a house, is your member shares. Because supposedly the housing co-op has been formed, meaning that it has members, and if it has members, then they should have invested some money, usually a £1 share. But what I might do is I might just we might just enter it as you enter the bank transaction, because I don't think, yeah, again, because it's just £1, I think it's fine to just do it when we enter the bank transaction. Okay, so I'm just closing this to tidy things a little bit. Okay, so there is, with the files I've shared with you, there's one that says bank statement.csv. And I don't know if people can open that CSV file, but what I'll do at least is I will share it on my screen, just we look at what's in there together. Can people see this?
Yes.
Brilliant. So this is basically a list of transactions, and it is a format in which you would download, or which you could download bank statement, or at least transaction listing from your internet banking. Like CSV is one of the most common file formats for that. But it usually will have, you know, different kind of information, different kind of columns. But at least we'll have the date, the description, so date, description, the reference numbers, and then that is a column that says that records the amount of the transaction, of each separate transaction, and this is a running balance. Okay, so it starts with the oldest transaction at the bottom in that case, and the most recent at the top. Okay, so we've got two choices. It's either you open one of those files manually, like I've just done, and then you go onto Gnucash, and you sort of in your bank account, you then type them up manually. Okay, but this can be a bit time consuming, especially because there is a way to do it automatically. So we will look at the automated way of doing it. Okay, so to import transactions, we go to File, Import, and then it gives you several options. Or what kind of thing do you want to import?
Oh, we can't see the drop-down menu on the screen.
I can't see the drop down. Okay, just give me a second. Maybe I didn't try it right. Yeah, I didn't try it. Can you see now?
Yeah, that's it. Cheers.
Okay, brilliant. Yeah. Okay, so then, yeah, so File, Import, and then you can import several things. In that case, what we want to import, you want to import transaction from CSV. Okay. Another common format in internet banking is OFX or QFX. Okay, so sometimes you can also import your transaction in those formats. I mean, export it from your internet banking and then import it to Gnucash. In that format, the process is very similar in the two. Okay, so for this example, we just import from CSV. So click on this. Then a window appears. So I'm going to make it smaller. And there's some text here that explains what you need to do. We'll just demonstrate it. So click on next. So then it asks to select the files. So I'm going to find the file, which is bank statement.csv. And I click on it. And then we get to that tab. So I'm just going to wait for everyone to be with me. Just maybe tell me if you're not. And then if no one says anything, I assume you're with me. Okay, so the first thing to select is which account are those transactions related to. So in that case, this is a bank statement for your current account. So we're going to select current account. Okay. So then they ask what is a separator in the file. In that case, it's kind of recognized it already because it could separate the different columns, which you can see are separated right. So the separator is okay, but depending on sometimes files just use weird formats, so you might have to change that, but most likely will be all right. Then you've got to select the date format, and that's quite an important one to get right, because otherwise it will be badly recognized. So in that case, we're not in year, month, and date, but we are in, days. We are in day, month, and year. Okay. Okay, and then here, you've got to select which column has got to do with what. So the first column, which obviously is fairly obvious, but you've got to select is the date column. Okay, and this is how things will be entered in your ledger. Okay, this column is a description column. This column here is where we can see the number. So this is actually the number column. And then that column here is whether things are a deposit or withdrawal. So it's the amount of the transaction. And because they're entered in the CSV file, they enter either as positive number if it's a deposit or a negative number if it's a withdrawal. So in effect, you select it as a deposit because a negative number would just be a negative deposit, therefore a withdrawal. Okay, so you select deposit here. And the last column, which is a running balance, you don't actually need to select because the running balance is done automatically by Gnucash. So you can ignore this one. So when you've done that, you select next.
How come why do some of the numbers have brackets around them in the deposit column? Some are in brackets and some aren't.
Okay, so because brackets, it's also it's another format to say negative.
Ah, okay.
Okay, so negative can either have a minus sign or a bracket.
Ah, okay, that's weird. Cool. Tab.
Okay. Invoice next. And then here, you've got a listing of all of the transactions that were recognized in the CSV file, and then it sort of proposes you to already match it, to already associate it with another account. Okay, because obviously all of those transactions are going to appear in a current account, because that's where we've chosen to import the CSV into. But then it says, okay, for each transaction, if you want, you can already associate it to where it's going to go, to which other account is being associated to. Okay, and so everything that's in yellow are transactions that Gnucash cannot automatically match. Okay, it's got no idea what the transaction is about. You've got to select it manually. But for some transactions, it says, oh, look, actually, I think I recognize those transactions already. Some of which because they may have already been entered. And indeed, we have already entered transaction to do with land tax and with solicitor fees and with the purchase. Okay. So those says, okay, I can automatically reconcile those transactions. You don't need to do anything. So in this stage, you can either select each transaction and say what it's going to be associated with. And to do that, you right-click on this, on where it says New unbalanced transaction, you right click on it and you say assign a transfer account to the selection. In fact, because all of the first transactions, the first 8 transactions have to do with the member shares, they are all going to be associated to the same account. So you can actually select all of them at the same time. Then right click and say assign a transfer account to the selection. Then there's a window that appears. And then you select where it goes. So just as a slightly trick question, so these are shares which are being paid into the bank account. So obviously they appear in the bank account. But in which account do you think these are associated to? What do you think is the corresponding account?
And they equity, because they were the weird transaction type you mentioned the other day, I think. So they were equity, and then there's a share capital section. Is that it?
That's right.
But I can't remember why
So,
they're that. I just remember they being the weird one.
Yeah, that's right. So so share capital is a form of equity. And so in fact, we said we said in the first session that your equity can be either seen as all of your assets less all of your liabilities, but that it also is equal to 2 things, which is your retained earnings plus your share capital. And in fact, in your books, you can see that under the equity section, you've got those 2 elements, share capital and retained earnings. Okay, and indeed, as part of your share capital, and especially in the case of the housing co-op where the only share capital is usually the member shares, then this is where those one-time payments are coming to. So you do select share capital, and then there now they appear in. Oh, sorry, I didn't mean to do that. They appear in green, and it says, okay, it's all being associated to an account. Okay. So then we have other transactions. So for example, loan fees, which were the fees that were paid when you took out the mortgage. So you've paid that out of your current account. And so you need to associate it to something. So where do you think that goes?
That maybe someone else. Sorry. So whoever else spoke, I'll let you answer.
The expenses.
Yes, it would be an expense. An expense, loan fees. Okay, but just so we kind of clarify something. So was it Harry that tried to speak? So you said that would maybe be an asset.
Yeah, I was thinking that in the same way that like the money from the loan the mortgage ended up getting transferred into the house asset. But I guess I was wrong. But yeah, that was sort of my thinking.
I mean, it's understandable why you would think that. Yeah, that's because the loan fees are just like some extra money you pay to the bank. It's not money that's been lent out to you.
I guess it's not adding to the value of the house per se. It's more yeah.
It's not neither adding to the value of the house, neither adding to your debt. It's just a straightforward cost. Okay. And then the other things. So for example, here we've got some furniture shop. So this is probably some stuff that you've bought in the shop to furnish the house. So again, where do you think that will come into?
House expenses.
Sorry?
Expenses.
Yep. Expenses. House expense. Oh, but you see, the problem is we don't really have a category for that in there. So ideally, we'd want to create a category, see if there's nothing that really fits what the expense is about. And so this is a case where, you know, you sort of, yeah, it's just not an expense that you either plan to put in your books or that you sort of plan for. And this is where, you know, your chart of accounts is something that is flexible. Okay, so in that template, we've already created categories which, by experience, know that most housing co-op will have those categories, but it's important that you sort of take ownership of your books and that you create categories that make sense to you. Okay, and when something is missing, then you kind of you create one, and you do actually have the option in here to create categories. Okay, so you can actually create a new account. I'm going to select house expense, create a new account here. Account name, we'll call it furniture. Then we give it color. And we press OK. And that's it. Okay, then the following transaction, which is a washing machine, we'll just put it in the same thing. Green insurance. So that's the house insurance. And again, this will be an expense. Oh, and now we've got that transaction. So what is that transaction, do you think?
Is it an adding to your asset, fixed asset, or an expense?
So actually, so before we say what account it corresponds to or what it is, so what do you think is the transaction about? Why do you see £5,000 coming out of your bank account?
It's an unpaid invoice.
Yeah, so you're paying the invoice from the contractor, so you're paying a bill. Yeah.
Yeah.
And in fact, you've already entered that bill in your books. That's good. And when you've entered that bill, you've already entered the expense. And because expenses are being like accounted for at the point where you receive invoice. Okay, so when you make the payment, then you're not double counting that expense again. Okay, but what you're doing is that now, after the payment is made, you don't have the liability anymore. You don't owe the contractor the money anymore. Okay, so this invoice will be associated to your liability account, current liabilities, and accounts payable, because that's where you list your bills. Okay. So I'm going to press OK in that. And again, just so you know, if terminology like accounts payable doesn't mean much to you, you could just rename that account and call it bills payable, for example. Okay, and that would just be exactly the same. Okay, does that make sense, that invoice?
Yeah.
Yeah, thanks.
Right. Brilliant. Okay.
I have two
So
questions. If it's so cool.
yes.
Sorry, if it's okay, if I'm not cutting you off in your stride.
That's fine.
Or,
That's fine.
yeah. So yes, two questions. When I imported them, my 3 loan stock investor ones, they've shown up saying do not import, no action selected, and they have nothing ticked in those 3 middle columns. And I mean, I guess I just tick them in the A column, but I was wondering, one, what do you know what would have made them come in as do not import? And 2, what do those like headings on those 3 like tick columns actually like mean? The A, U plus C, and C.
So I wonder if there's no tooltip that actually tells you. Can't remember what the C stands for actually, but it must mean something like reconciled or match, or it basically means that it's sort of automatically recognized, the C.
Okay.
The A means add. Okay, so which means add as a new transaction. Yeah. And then U plus C means update. So your U is update plus C, and C, I mean, C must be something like, you know, it's about kind of not creating a new one. So I think it's like, okay, that transaction doesn't already exist. We're sort of matching it, yeah.
Okay, cool.
And sorry, the first question was, why did they not appear? So basically in your book, they were like that, yeah?
Yeah. And I just wondering, I mean, I must have done something different, I'm guessing, but I wonder if you know what that could be.
I mean, not necessarily. Sometimes Gnucash do treat files slightly differently. So, and maybe it was like that, maybe I ticked it like automatically, I don't know. So I'm not sure actually why that is. But as a matter of fact, it's actually good because we do already have those. And it is, I wonder if, yeah, I'm not entirely sure what it. Yeah, it's possible that you can actually just. I don't use that function very often actually, so it's actually possible you could just select the C in here because we've already actually entered those 3 loan stock transactions. So you know what, we'll do it together. And we'll just try to press C because it seems to recognize that those transactions have to do with the one we've already entered. So in fact, for the 3 loan stock transaction, we'll just press C and see what happens.
Do we know that it's assigned them to each of the correct investors, or would it have like, you know, maybe like it's got them mixed up, or, you know, can we sort of trust that automation? Or I don't know.
I mean, so it, as a matter of fact, hasn't. Like, you know, the one that is sort of associated with the first one is wrong. Like the second one is right. But the point is, I don't think it actually matters in that case. But we'll just see what it does. We'll look at it together. So I think it's just yeah.
Okay, tough.
Okay. And so before we keep going, so we've done like a fair chunk of the transactions. We've sort of associated them. Before we actually press apply, and before we keep going, we're going to do something else, which actually I've skipped in my process, which I should have done before we actually do the import. So obviously, once you've bought the house, something that happened is that people have somewhere to live. So they're going to move in, and many are going to start charging rent to them. And on a little PDF about house purchase, I do mention that. So the house is bought on the 20th of November, and then the co-op starts charging rent to its members on the 19th. Sorry, on the 1st of December. Okay, and so we're going to enter those transactions which corresponds to the co-op start charging rent to members. Okay, and so when you charge rent to member, it's a little bit like an invoice in a sense that it's money that's owed to the co-op. So it's a form of assets. We're not in that case actually using the invoice function because that would be just way too sort of convoluted. And as someone pointed out at the last session, the kind of the overall invoice in a sense is a kind of tenancy agreement. So what we just want to enter here is a transaction that reminds us that members owe the co-op money every month. So this will be a form of current assets because it's an amount of money that's owed to the co-op in the short term, yeah, i.e. monthly. So in current assets, there's already a category called rent receivable, and within those categories there's a list of members. Okay, and again, this is a rent due for each member. Okay, so in fact, we could even rename those accounts and call it rent due member 1, and so on. Again, so obviously, ideally, because we said that this housing co-op's got 8 members, we want to create more accounts. Okay, we might not do the 8 of them right now, just because of time, actually. Because the idea is that we could create as many accounts as we want. Oh. Maybe the name is getting too long, actually. Odd. For some reason, it's not letting me write the full name. But anyway, you sort of, write people's names or something like that. In any case, it wouldn't be like that in your real books. You would have actually have people's names in here. Yeah. So say if we take the example of member 1, so we'll say that we charge member, or everyone has got the same rent, and we're going to say that the rent is £350. Okay, so if we open member 1, so we say we start charging rent from the 1st of December 2020. Okay, so we enter the transaction as rent due, because that's when the rent is actually being charged. Okay, and this is when the co-op records the income. Then we select income, rental income, and that would be an increase because that increases your assets. Okay, the co-op got so many dues, it's 350. Okay, but then we know that that is going to be the case every month. Okay, and so we could either manually do it every month, but then there's a risk that we forget to write that down. And then if we forget to write those rent charges, then we might actually miss some information, or we might miss that actually a member owe us some money and we didn't record it. So you can actually, for transactions that happen on a regular basis, you can schedule them. Okay, to schedule a transaction, you click on the transaction and you right click on it and you select schedule. Or if the transaction is selected, you can go to transaction, to action and schedule transaction. Okay, but best is right click, schedule, and then you've got the schedule transaction editor. So again, it asks for the name of the transaction. So rent due is fine, the frequency, then you choose monthly. The start date, which will be the next time this transaction appears. It will be then the 1st of January, 21. And then it asks, okay, does that have an end date? Or do you already know the end date? Is it a transaction that's only going to happen 10 times, or that's going to end in May or whatever? In that case, for members rent, usually we don't really know, unless you know in advance that someone's going to leave, but usually, so you select never ends. And then you press OK. So that means that next time you, so say if you were ready in December 2020, then when you open Gnucash next in January 2020 at some point, then the transaction will be automatically created. Okay, so in fact, Gnucash is going to ask you when you open it, you're like, oh, those transactions are meant to be created because it's scheduled. Are you sure you want to create them? And you press OK. But if you do your book in a kind of retroactive way, like we're doing now, you can actually also generate those transactions automatically since the point you've entered it. So for example, in that case, we've created one scheduled transaction for this member. You could go to Action, Schedule Transaction, and since last run, and you press this, and then you get that window that appear, and it says, oh, look, these are all of the transactions that are due to be created. Okay, and then you press OK, and they all appear up to today. Because in Gnucash, you think, okay, you just opened Gnucash today. We're in November 2021. So since this first transaction up to today, this is all of the transactions that should have been created.
Sorry, I had to tab out for a second. How did you get that menu up to generate all those again? Sorry, I missed that bit.
So it was in Action,
Actions.
Schedule Transaction, since last run.
Okay, cool. Thank you.
Okay. But actually, for the purpose of today, we're actually going to delete all of those. I mean, you can keep them in your example if you like, but and so to delete, you just again like select the transaction and then press delete at the top. Okay, and then supposedly, then you're supposed to do exactly the same for each member. So again, 1st of December 20, rent due. And of course, if you don't charge every member the same amount, then you write whatever amount is relevant. But in the, so we select the income, rental income, increase 350, and you do exactly the same for all of the members. You can even probably, I'm going to try because I'm not sure it always works, but you can probably copy the transaction and then paste it, maybe. Yes. You just go to adjust the date. So because we know we want to create actually exactly the same transaction for all members, you can use a copy and paste function. So you select the transaction, go to transaction, copy, go to another account, and then transaction, paste. The only thing that doesn't get copy and pasted is the date. So you go to adjust the date on the time. Okay. Okay, so we might actually just create a few more of those members. Yes. 5. And 6. Seven. And then copy the first transaction into all of them. Changing the date each time. Okay, and so whenever you're done with this, what that tells us is, so for every member on the 1st of, since the 1st of December, they all owe the co-op £350. Okay, which means that the total owed to the co-op as rent receivable is £2,800. Okay. So if we then go back to the list of transactions that were supposed to enter from the bank statement, then we start to see some rent payment coming in. Okay, do stop me if it's going too fast or anything, or if you have any questions. Okay, so again, so those rent payments, we're going to assign them to each kind of relevant to each member, so to each kind of member account of rent outstanding, of rent receivable, because now the rent's been actually paid. Okay, so the rent payment will decrease the rent receivable for each members because they have paid the rent, and will increase money in the bank. So it's a transfer of assets between the money that's owed, that's due to be paid to the co-op, and the money that's received. So if we say that that's member 7, so we're going to assign it to member 7. So current asset, rent receivable, member 7. And then we do the same to every member, for every member. 8. Member 4. Okay, member 3. So after member 3, we can see that there's a transaction that says Ecology Building Society. This is, of course, an example. It could be Traders Bank, or it could be any other society, or any other bank. And this would be how a mortgage payment would appear on your bank statement. Okay, we're not going to associate that transaction yet, because we'll see that mortgage payments are a little bit particular as transactions. But we're just going to skip it, this one, and we're just going to keep going, assigning for members. So member 1, member 2, okay. Now we've got council tax. So then council tax will be an expense. So assign it, expense, co-op expense, or actually house expense, council tax. And then account charges. So this is, for example, if you're banking with a bank that actually charge you money. So there's some banks do that quarterly, for example. So then we'd have we'd assign that as an expense. That'll be under other co-op expense, and then banking fees. Then bank interest. So this is if you, for example, you would receive interest on your current account, which nowadays is rare, and even if it's the case, it's usually tiny. But still, that will be a form of income. So you would assign that transaction as income and bank interest. All right. So we've done all of them except the mortgage, but it's fine. And the thing is, the mortgage, we haven't unticked that one. We just said that it's going to be entered in our bank account ledger, but it's not going to be assigned to anything. So then we press apply. And then close. And so if we go now to our current account, then we see all of those transactions that have been entered. Starting with the member shares, then the loan stock. In fact, the loan stock, they haven't been updated. It's just the one we've entered manually. Okay. But so now, so we've entered all of the transaction. We're at the end of December of 2020, and so we can look at how, you know, how are we doing with things like, for example, members' rent. So if we go back to the chart of accounts, we see that by the end of December, still we have £375 of outstanding, and that tells you straight away that the co-op hasn't quite received as rent all of the money it should have received. Okay, so if you expand this, then you can look at it in details, and you see that, actually member 6, we haven't received any payment, and member 7 has underpaid by £25. Okay, so if I open any of those accounts, so for example, member 1, we've got the rent due transaction, which we've entered, and then the rent that was automatically imported from the CSV, so from the bank account, showing the rent payment from member 1. Okay, so there we go, the rent due, rent payment. The rent due is increasing the rent outstanding, and the rent payment is decreasing the rent outstanding. So for member 1 is 0, and we're all happy. But then for member 6, we've got no transaction for rent payment. And then for member 7, we've got a transaction for rent payment, but not quite of the right amount. Okay. So which is why it is useful to do this rent due business, so we can compare it. So we can compare the rent due with the rent payment. Another thing to note in the bank account, and if we look at this, so we are beginning of October 2020, and members have joined, all happy. Beginning of November, we received loan stock investment, all happy. And then we did the purchase. Oh, no, sorry. Then we took out the mortgage, or we sort of engaged in the mortgage process with the bank, and we paid the mortgage fees early November, so just before we actually did the purchase on the 19th of November. And then we obviously did the purchase, bought some stuff for the house, paid the house insurance, paid the contractor, okay, and then we started to get some money from members. That's great. And then we had our first mortgage payment. But if you look at the running balance here, it says -72. Okay, meaning the account kind of went in the red. But in fact, the account didn't go in the red, because on the same day, we also received a rent payment from member 3 on the 19th of December of 350, which brought the balance back up to 278. Yeah. So in fact, because of the orders, the transactions are written down, it looks like the account went in the red, but in effect, it didn't go in the red. But what tells us, though, is that it's good that that member actually paid on that day and not any later, because otherwise we would have gone in the red. Okay, so some members paid in the middle of the month on the 15th. Some members paid a little bit later. Some members paid even later, members 3, 1, and 2, whereas the mortgage arrived on the 19th. And what that tells you is when you ask member to pay rent, you've got to kind of look at what kind of expenses you have monthly and when those expenses are supposed to come in. And especially one of the biggest expense for housing co-op are mortgage payments. Yeah, so you kind of want to make sure the rent's coming in, like unless you've already got kind of cash reserves, but at least at the beginning, you kind of want to make sure rent's coming in before the mortgage payment. Okay. So anyway, one of the last things we're going to do is entering the transaction for the mortgage, okay, which is one of the most kind of tricky bit. And then we'll do 2 last things after that, and hopefully we will finish almost in time. So someone said they have to leave at 1 sharp, so or maybe even before. Okay, so why didn't I enter the mortgage payment like every other transaction? That's because when you repay your mortgage, this is actually split into 2 parts. One part is you repaying your debt, which reduces how much money is outstanding on your mortgage, so you repay the bank part of the debt. And another part of that payment is the interest. Okay. So just for the purpose of now, we're not going to work with the actual real split between capital and interest on that payment, although the total amount is actually the real amount you would pay on a £360,000 mortgage. So how do you do that when one transaction actually splits for 2 things? So there's a functionality called split transaction. So if you select the transaction and you right click, then you have an option to split, which I can't see. Oh yeah, there it is. So if you click on split, then it sort of expands a drop down for the transaction. Okay, and as you can see, one of those lines is already filled in with the original transaction, which the one that's kind of here, which is the current account, which is where we are at the moment, and how much was in that case taken out of the current account. Okay, but then it says, look, you've got to then associate that transaction to other things. And so here you choose in which other account that goes. And as opposed to other transaction in that account, it's not going to go to only one place, but it's going to go to 2 places. So one of the places it goes to will be the places when you repay the debt. So you select the drop down, you go to long-term liability, mortgage, and let's say that, for example, on the first payment, you only £600 goes towards repaying the debt. Okay, so you put 600 here, you press enter, and then it says okay. So you've assigned £600 out of the 1,500, but then you've got £900 left to assign. And this £900 you then select as interest. So in this case, you select, you go to expenses, because in that case, interest is an expense. Loan expenses, mortgage interest, you select that and you press enter. Okay, and now your transaction, which is £1,500 coming off your bank account, it's split into two different things in your books. One part is debt repayment, another part is interest repayment. And then you press enter, and that's it. Okay, but instead of seeing here right away where the transaction is associated to, it says it's split. So if you want to see it, you either got to expand the split by right-clicking, or you can also click on the split button at the top here. Okay, split transactions are a little tricky to, I mean, the concept is kind of easy, but the practicality of it is a little bit weird. So it's probably something you'll have to practice a little bit before you get the grasp of it. But a nice thing anyway is that because mortgage payments also happen on a regular basis, what you can do once you've done it once is right-clicking and duplicate the transaction. So it's likely that it's going to happen again the following month. So it's going to be the 19th of January, 21, around the same time. So that transaction is created automatically. The amount is likely to be the same unless the interest has changed. However, the split will be different because every month there isn't the same amount that's allocated to repaying the capital and repaying the interest. And in fact, as time goes, you pay more and more capital. So for example, the following month, it might be something like, £612. And then in terms of interest, then the interest will have reduced by £12. Okay, so total amount stays the same, but the split between interest and capital changes every month. Okay.
Yep.
Excellent. So this is actually, so everything we've done up to now is actually most of the things you will have to do in a housing co-op. Yeah, literally, this is kind of the key transactions. It's only looking at you over 2 months, but basically everything repeats every month, more or less. And in fact, things like insurance or whatever only happen once a year. And of course, anything related to the house purchase usually only happens once. But everything to do with kind of rent payment and rent charges and council tax and mortgage payment is kind of always the same. So if you learn how to do this well, then doing the books is going to be easy. So one question is, how do you know the split between the interest and the capital? Well, this should be provided by your mortgage provider. So every 6 months, usually, your mortgage provider will supply you with statements which will detail the split between capital and interest. Okay, so obviously, because you're going to wait for 6 months, unless they also do internet banking, but not all of them do that. But because you're going to wait for 6 months, then it's likely that those transactions are going to remain unassigned until you actually receive the statement. Okay, which is fine, but you still want to import them and you want them to be in your current account, so you get the accurate running balance on your current account. But the split or the way it's being assigned, you can't really do until you get your mortgage statement, or unless you use a mortgage calculator and work it out by yourself, which is possible, which we also provide a mortgage calculator if you want to do it. But it's also fine to wait for your mortgage statement. Okay, so I'm just going to delete that transaction. Okay. So what is next? Okay, so let's say we now get to the end of the year. Well, we actually do get to the end of the year because 31st of December, but let's say, we sort of run the housing co-op for a year, let's pretend. There's a few things that needs to happen at the end of the year of the housing co-op. Actually, sorry, two little things I'm going to mention now, so it's out of the way. When you have transactions that are unassigned, then there's a new account that's being created in the chart of account that says imbalance GBP, because we're working in British pounds. So the imbalance, that basically says imbalance transactions, and all transactions that are being unassigned are listed in that ledger. So that helps you to keep track and to see if you've forgotten to assign a transaction. You see it straight away in your chart of accounts. Okay. Another small thing about accounts is, you see, we have like top level accounts, like assets, equity, expenses, income, and liabilities. Then we kind of break things down into as many kind of categories as we want and into as many levels as we want. But yet we usually enter transactions only on the lowest level. Okay, so in that case, for example, we don't really enter transaction in loan stock, but we enter transaction into each individual investor. And in fact, if you right click on this account, it's got that little thing ticked here that says it's a placeholder. Okay, and when you tick that, you explicitly say that in that account you cannot enter transactions. Okay, so if I open this, actually, does it even let me open it? Well, it doesn't even let me open it, actually. Yes, you can't even open it as a ledger, apparently. Before you used to. But... yeah, okay, no, so it lets you open it if you click the open button, but it tells you in this account you can't write anything. Okay, so you can basically specify which accounts you can actually list and enter transactions and which accounts you can't. Which accounts are just used as overarching category. Just small information with accounts. Okay, so let's go back to what happened at the end of the year. So there are a few transactions which are not cash transactions, but which you need to enter at the end of the year. And that, mainly in the case of housing co-op, will be things like loan stock interest. So with loan stock, it's either you pay the interest yearly to investors, but it's quite often the case that even the interest is not being paid out to investors as cash, but is being added to their loan stock investments. And then at the end of the term of the loan stock, you will repay both the capital, the original capital that were lent to you, plus all of the interest that, that have been acquired throughout the period. Okay, so for example, if we take investor 2, they've invested 45,000 at 1% interest, meaning that after 1 year, so say, obviously it will depend on the term of loan stock as when you start acquiring interest and everything, but for sake of demonstration here, I would just take exactly 1 year. So 10th of November 21, you will then add an interest payment. Oh, not an interest payment, but an interest accrual. So you can write it, for example, year 1 interest. And so in that case, that will be an expense because interest are always expenses. So loan stock interest, and it will increase the liability. And so it will basically be 1% of 45,000, which will be £450. Okay, so now the outstanding debt after 1 year of this investor is £45,450. Okay. If you pay interest in that way, meaning you don't pay it at cash, but it accrues, then loan stock becomes compound interest. So year 2 interest, so the 10th of November 2022, year 2 interest, it won't be 1% of the original amount, but it will be 1% of that amount, of that new amount. So still be loan stock interest, but instead this time, the interest will be £454.50. Okay. By the way, the blue line always appears if you enter a transaction in the future. Okay. And again, you can use a loan stock interest calculator or a compound interest calculator. So you know, and you can even enter all of those transactions in advance, so you don't forget to do it as to when the interest is due. Okay, and so you could actually enter 10 years of interest because you know exactly what they're going to be.
Is there a way we can calculate the compound interest with the schedule function, or can we not use that because it's compounding?
No, not the schedule function, no.
Okay.
But you can use a very simple spreadsheet. I can even share it. I can put those spreadsheets if you're on the loan calculator and the compound and the loan stock interest calculator. I can put it in a folder that I've shared with you. We've got them with Catalyst.
And will that interest payment show up as a pro rata amount at
What
the
do you
end
mean
of the
by-
financial year?
So no, basically. The simple answer is no. It will only appear whenever it's due.
Okay. Good. It's easier.
Okay. Right, so this is so interest payment again. So the kind of transaction that you have to manually. There's not cash transactions. So you just go to do it every year. Well, each year after an investment has come in. Yeah. So it's sort of good when you actually enter the investment to kind of write down the interest right away, so you just don't forget about it. A transaction that also happens every year, except the year that you've actually bought the house, but every year afterwards. So either the year where you've bought the house or any year you got a revaluation of the house. But I won't enter the realm of reevaluation for now. But you know, every year you're supposed to depreciate your assets. So the way to do that is that you go to assets, fixed assets, house. And so again, so we sort of say the end of that financial year would be 31st of December 2020. We wouldn't write it then, but we would write it at the end of December 2021. Yeah, so you have depreciation. And basically, depending on the property, but you know, in kind of simple way in accounting practice, like you kind of depreciate property at 2%. Okay, so it's a 2% depreciation. Technically speaking, the land is not depreciated. So technically speaking, you want to separate between the building and the land. Not many people do so. It's probably, yeah, depending on where you're at, it's probably not a big deal not to do it. But definitely, if you were like a larger co-op, you know, building a co-housing and something like that, then you would really want to separate those two because the land does not depreciate, only the building does. Okay, but again, if you do get a valuation that splits between the value of the building and the land, then you just want to depreciate the building. But just for illustration purposes here, we're just going to depreciate everything that's here. So depreciation is an expense that reduces the value of your assets. So it's entered in that asset account, or it could be entered in the expense account. But then if it's entered in the asset account like here, you want to link it to the depreciation charge. And again, that is a case where the account does not exist. So we need to create it. So you go back to accounts, expenses, house expenses. Actually, I don't think it exists. Yeah, house expenses, and you want to create an account, new account, depreciation. Okay. So you select that account. And so it's going to be 2% of whatever the value is, whatever the original cost of the property was, but the original cost in that sense includes any other, so it includes the property price and any other capitalized cost to start with. Okay, and again, the capitalized costs are the loan transaction and the solicitor fees in that case. Okay, so then we take the total amount, which was 484,700, 484,700. We take 2% of that, and that is 98694. So the depreciation charges is 98694. After depreciation, the book value of your assets has gone down. Okay, and so this is one of the things you need to do every year, again, except the year when you either buy the house or the year when you do a revaluation.
How would you manage it? Say you were like getting the house remortgaged and you got like a new evaluation. Would you do kind of like say if it had increased in value because you'd done work on it, would you do sort of like an appreciation and do like the opposite? Or?
So yes, but there's a few technicalities around that, and I'm not entirely sure I do have time. But, you know, maybe for people who want to stay afterwards, we could discuss that if you want.
Okay, no worries. Yeah, I guess maybe that's
in general.
Yeah. No worries.
Sorry, it's always hard to know, you know, what to include, what not to include in within the time constraint. But you know, because that does not happen all the time, and remortgaging is not a usual case and stuff like that. The main thing you need to know is the fact that you do need to depreciate every year. Okay, and the other task that you need to do is to close the books. Now you don't really have to do it, but it just makes things clearer. And so if you go to, so there's so closing the books, well, that means basically, so at the end of the year, or after a set period, let's say, you kind of look at, okay, so how much income did we get? How much expenses did we have? What is our profit for the year? And you find an amount. And then you will want to look at that same thing for the following period. So, you know, next year or whatever. But then when you look at it, you don't want to look again at all of the numbers from the previous year. You just want to look at it for that particular period. So you kind of want to start from zero again at the start of every new period. And this is what closing the books actually does. And so for that, there's a tool, there's a function. So you go to Tools, Close Books, and then you choose a date at which you want to close the books. Okay, so for example, in that case, what would make sense? Well, let's say even so we choose the end of the year end, basically, so 31st of December 2020. And then it asks you, okay, where do you want to record that particular profit, if you say for the year? So where do you want to record your income for the year? Where do you want to record the expenses for the year? And because the sum of the two is your profit, and because the sum of all of the profits from the previous years are what we call retained earnings, we select as an account equity retained earnings in that case. Okay, and then you press OK. And so what you can see here is most of those accounts have gone back to zeros, except those when we enter a transaction in the future. Okay, i.e. after the date we've closed the books. So these are things like depreciation, and also when we did the loan stock interest, which were in the future. Okay, but then say if I open, for example, the furniture account, when we add some furniture, so we had in 2020 we spent some money on furniture and on a washing machine. Okay, so at the end of 2020 we spent 2,000. And then there's that transaction, which is a closing books transaction that kind of resets everything to zero. Okay.
Say we did that by mistake, how would we reverse that? So if we were like, oh, whoops, I didn't mean to close the books. Like,
yeah, you just, okay, so you would go to the equity retained earnings, and then you see the two transactions, the two closing book transactions, and you just remove them.
Okay.
So you just delete them. You delete, and you delete, and that cancels it.
Cool, thanks.
Okay. Okay. Sorry, we're running a little late. Yeah, I mean, if people need to go, that's fine. The other two things that I did want to go through was reports. They won't take much time, but I think it might be useful. So there's a variety of reports that are available in Gnucash. But the key one, or the two, I'm just going to present two reports, but the key one really are the one that you need to present, that you need to do for your annual accounts, and ideally the one that you need to present to your members as well. So one which is a profit and loss, so which is how much profit have we made over a given period. Okay, and the other one is a balance sheet. So the balance sheet, you find it is assets and liability balance sheet. Okay, and the other one you find it into business. Oh no, actually into income and expense, profit and loss. So let's start with the profit and loss. So when you click on it, it sort of generates automatically a profit and loss, and by default, it will do it for the current financial year. So the financial year, so it's 12 months you're in from the point you open the Gnucash file. But maybe that's not really the period we're interested in. So you can go to Option, General, and then change the date. So you could say, for example, so you can either enter the date manually, or you could choose some presets, like for example, start of the previous year, and then end of the previous year. Okay. You can also change the way it's being displayed, so you can, omit accounts that have zero balance, so you can kind of change a few things in there. You can also change the style. One style that I think is nicer, I think is easy actually. So then it's sort of looking a little bit friendlier, and and then is now for the previous financial year. Okay, and that gives you your total profit or loss. In that case, it's a loss. Okay, and then similarly for the balance sheet. Oh, sorry, I do realize I'm rushing a little bit through this, but I mean, report generation as well is something you can sort of learn a little bit more by yourself, I suppose. It's yeah. Also, by the way, another document that I will include in that folder are the actual guide for Gnucash. Because they're very useful in terms of learning how to use the software, but also because they're a brilliant reminder of accounting concepts. So those guides are super well written. This is actually like really back in the day how I learned accounting concepts. I knew nothing about bookkeeping or anything, and I was asked to do the books for a small like workers co-op. that no one doing any finance, and I just read the Gnucash manual and I learned a lot of the concept from there. Okay, but so the balance sheet, again, you can choose, so you can choose a date of the balance sheet. So for example, the end of the previous year, which then will be the 31st of December 2020. But you could also choose a manual date. You could choose again the style and some of display options and a few other options. But basically, that gives you a balance sheet, which lists all of your assets. So again, your assets being within your current assets. So any money in the bank, any rent receivable, so money that is due to be paid to the co-op that hasn't yet been paid. Your fixed assets, which is the house and all of the costs capitalized on the house. And then all of your liabilities, which is basically your debt. So any bills payable, we've got 0 because the only bill that we had, we've actually paid it. And then the 2 types of loans, so the mortgage and the loan stock. Okay. And so if you look, you've got less assets than you've got liabilities. And so your equity is negative. Okay. And then we know that you've made a loss of, so you've made a loss because we looked at the profit and loss. So you've made a loss of £8,484.62. And your total equity is that amount, but you also got £8 of share capital. Okay, so if you add so minus 8,484 plus 8, that will give you minus 8,476, 62. Okay, so your total equity being your retained earnings, in that case, the loss for the year, plus your share capital. And again, this is something we sort of brushed over, the relationship between like equity and kind of retained earning and share capital and equity, because this is the accounting equation, but this wasn't dug into much detail last session because no time. But this is how you read a balance sheet basically. It's looking at assets and liabilities. If you do that minus that, you're supposed to find that amount. And that amount is supposed to be your retained earnings, so all of the previous profit and loss plus your share capital. Sorry, I know this is probably going too fast and it's confusing, but feel free to ask any question. But we are pretty much done for today. And there's one question that I didn't answer earlier, which was around why are some of the costs capitalized? What is the reasoning behind that? So I'm happy to answer that question, but again, if people need to go, that's fine. So I might just quickly answer that question. So we looked at, so as part of the costs that were being capitalized, we're like, okay, so it's not, so we don't, when you look at the value of our asset, we don't just look at the purchase price, but we also add some of the cost. And why do we add those costs? So we add those costs because they are costs that have to do with the purchase. So that have to do with the capital expenditure on your house, right? So you're buying the house and kind of you add those costs to it. And this is because two things. Because these are costs that have to do with the capital expenditure, with the purchase of your house, they're not accounted as expense, because if they were counted as expense, you could then offset your trading income, your rent, against those expenses. But by nature, they're different things. Your trading income is a revenue, it's not capital, while those expenses have to do with capital. Okay, so which is why they capitalized and they're not entered as trading expense. Okay, so you can't offset them against your trading income. Mind, in the case of a housing co-op, that would be irrelevant because we don't count rental income as income for tax purposes, but for any other rental business, that would be the case. But however, you can offset those costs then against capital gain tax. So if your house gain value, okay, so for example, we bought the house for 450, but actually we've capitalized some other costs, meaning that the value here is not 450, but it's 484, 700. But say your house is revalued at 490,000, which is 40,000 more than what you bought it for. So if you were paying capital gain tax, which again is irrelevant for housing co-ops because we don't pay capital gain tax, but if you were going to pay capital gain tax, then normally you would pay tax on the extra 40,000. Except that you can actually, because you've capitalized those costs, this offset, you're effectively offsetting those costs against that tax. So instead of paying tax against 490,000, you're only, over the 40,000 extra on the purchase price, compared to what you've capitalized, it's only going to be then 5,300. So you would only pay tax on a gain of 5,300 instead of 40,000. So that's why some of the costs are capitalized. It was a bit obscure, which is why I didn't want to talk about it in the workshop. And also mainly irrelevant for housing co-ops because we take rental income into account for tax purposes, nor we pay capital gain tax. So there we are.
It's interesting, isn't it? Because that would be a mortgage cost, wouldn't it? The land transaction tax. Quite often it would go on to you'd have to, for a co-op, you'd have to raise money for a mortgage to pay that, or through the loan stock.
Yeah.
So in effect, you're creating a kind of negative equity situation if the house price doesn't go up, right?
Yes, I mean you're kind of creating a negative equity situation, but not really, because those costs are actually added to your assets. So while you're borrowing from them, they also added to your assets, right? So that is also added to your equity.
Okay.
While you're creating a negative equity situation is because in a case of a housing co-op, you also, there is basically some other kind of costs that are incurred, like some repair costs and some other costs that you might not recover. So you do start usually with some negative equity.
Okay. Jacinta had to go. She says, thanks very much for the.
Yeah. Yeah, well, thank you too, or Dior. My Welsh is not very good, sadly. Also, Welsh with a French accent, I'm not too sure what that gives. But yeah, but where you might end up in a negative equity situation, though, is because you do capitalize on those costs. If then the house is revalued like quite soon after, and the value doesn't go up very much, then those costs are being effectively cancelled. So, because say, for example, you revalue that house just, 2 months later, it'll probably be revalued at, 450 or close to that. And if you are using a method into your book, which we call the revaluation method, where you kind of update your asset value on a regular basis through revaluation, which I don't advise to do, by the way, then you would effectively make a loss, and then you would end up in more negative equity. Okay, and basically housing co-ops, because the nature of the property, because your property is not considered as a commercial property, you're not actually, you've got a choice on how you treat your property in your accounts, and now you treat revaluation, and so you don't have to follow what's called a revaluation model. And the other term actually escapes my mind right now, but it's basically the kind of ongoing cost model, where you just kind of depreciate your value, like you depreciate the original cost, what you've paid for your property originally, and you depreciate that by a certain amount every year, usually 2%. Okay, and it's always 2% of the original cost, yeah?
Yeah.
So in the case of loan stock, we are kind of compounding interest every year, but in that case, it's not, you don't take 2% of the new amount that's in the book after a depreciation. Yeah, it's always 2% of the original amount. So the yearly depreciation is always the same amount.
Okay. Yeah. Thank you.
Of course, like, when you get in all of those details, there's always sort of quite a lot of technicalities, and like, which is why sadly sometimes accountants or people who know that can still be useful when there is for those kind of nitty-gritty bits. But hopefully with basic knowledge of accounting principles, some knowledge of bookkeeping principles, and learning with the bookkeeping practice, you can do most of those things yourselves.
It's been super helpful the last couple of afternoon and morning. And if people want more specific advice, it's right that they can contact you as Catalyst,
Yes.
Can't they, and commission you to do work for them. And
yeah, I mean, if you actually need some work to be done, like so two things, like it could be either like a follow-up workshop or something like that, or it could be like work in terms, can you help us with our bookkeeping? Can you help us with our end of year accounts? Then we can do that, and that will be sort of the work we can charge for. However, if you just want an advice, like I'm struggling, how do we enter that transaction, for example, then you can just contact me, and that's we also like, give a lot of free advice here with Catalyst. That's something we do.
That's really fantastic to know.
Thank you so much. What would the contact details be for that?
So I mean, it could be me directly. So it's Gauthier@catalystcollective.org, or more generally, which might also be good, is info@catalystcollective.org. Both of those are, I think, on the front page of the presentations, and both presentations are available in the folders I've shared with them.
Cool, yeah, thanks so much. So yeah, it's been very, very helpful. This is, I mean, I think my brain needs to like process stuff, and when I actually look at our own accounts, I feel like then stuff will slot into place. But this has been absolutely, yeah, fantastic. Thank you so much.
Thanks. I'm glad you were helpful. I mean, if anyone's got any sort of feedback, or like, obviously positive feedback are always good to hear, but also kind of anything that you felt were not ideal, or could have been different or better, that would be useful to hear, because actually we don't often do this kind of combined workshop where we kind of combine accounting principle and bookkeeping. Normally we really kind of run two workshops, one which is kind of a full day workshop on just accounting principles, and then another one on bookkeeping. So again, it was a little bit of an experiment in a sense, or I've tried to kind of combine it in a way that made more sense to me, but I'd be quite happy to hear either things that worked well or things that didn't work so well. So that would be good. I mean, I know there aren't that many people now, but maybe Alan, you can actually ask.
I will, yes. I can definitely do that. I'll send out the resources that you shared again, and when we've uploaded the video, I'll send people a link to that and then ask them for the feedback. Yeah.
But then, but if there's anything that people still present want to feedback, that's cool as well.
I mean, from my point of view, I think it's worked well. It's been really helpful. Okay, if I will stop the recording now, I think actually.